All right, let's just get this out of the way. If you're watching this, you're probably either a crypto millionaire checking your portfolio for the 100th time today, or if you're someone who just heard the word Bitcoin and thought, is it too late? Either way, welcome to CryptoLogic Deep Dive. I'm Sash, and today I'm taking you through the entire market landscape from the numbers to the regulations and how global central banks are still pulling the strings. Let's start with the numbers. Bitcoin is fighting to hold a key level today. We are seeing BTC trading around 141k, a slight dip of about 1% over the last 24 hours. The global market cap is sitting at a hefty $4.7 trillion. Now, that 141k level is absolutely critical. It's a psychological and technical line in the sand. The mood, frankly, is one of the consolidation and caution. We're seeing the market take a breath after a pretty volatile few weeks. Investors are trying to figure out if this is just a healthy pullback or if we're settling into a deeper, longer-term bear cycle. The key is that Bitcoin hasn't completely broken down, but the momentum is definitely on the side of the bears right now. This is a classic risk-off environment, and it's a direct result of the global macroeconomic picture. Okay, before we dive into the deep end of the bear market and Canberra's paperwork, we need a quick palate cleanser. I've got a crypto joke for you. Maybe I've said it before, you've heard it before, but what the hell, why not? Why did the Bitcoin investor break up with the Ethereum investor? Because he said she was too stable. All right. Now that we have got that out of the way, out of the system, let's get serious. I mentioned the bear cycle. The global market is down about 23% from its October peak. By traditional financial metrics, a 20% drop defines a bear market. So, are we officially in one? That's the $1 million question, or perhaps the 141,000 or 141k question. Yes, by the numbers, we've crossed that 20% threshold. But crypto bear markets are a different beast. They are often brutal, long, and shake out the weak projects. If you look back at the 2018 cycle or even the 2022 collapse after the FTX scandal, the market saw drops of 70% or more. This current dip feels like a catastrophic collapse and more like a necessary correction after a period of rapid growth. The market is maturing, but it's still highly sensitive to global economic indicators. What's different this time is the sheer size of the market. 4.7 trillion is a massive pool of capital. This means the sell-offs are bigger, but the underlying infrastructure is also much stronger. We're not seeing the same level of panic selling, but rather a slow, grinding decline driven by macro factors. And that global caution is hitting the corporate world too. We're seeing pressure on the shares of those companies that hold a lot of Bitcoin on their balance sheets. It's a double-edged sword for them. These crypto hoarding companies, as some call them, essentially act as leveraged bets on Bitcoin. When the price drops, their core asset value declines, and their stock price often falls even harder. Investors are re-evaluating that risk. It highlights the growing interconnectedness, it's a word, between the traditional stock market and the digital asset space. It's no longer a fringe asset. Its volatility is now impacting major corporate balance sheets. Now, let's talk about the elephant in the room: central banks and the interest rates. This is the single biggest headwind facing the crypto market right now. Think about it. Bitcoin and Ethereum are non-yielding assets. They pay your interest. When central banks like the US Federal Reserve or the Reserve Bank of Australia raise interest rates, they increase the opportunity cost of holding something that doesn't generate a return. Suddenly, a safe government bond paying 5% looks a lot more attractive than a volatile asset like Bitcoin. We've seen this play all year. Every time a central bank official hints at a pause in rate cuts or even suggests rates might stay higher for longer, the crypto market reacts negatively. High interest rates scare investors away from riskier investments like crypto. Conversely, the lowering of rates is seen as a positive catalyst. The market is currently pricing in a very cautious approach from central banks, which is a major reason why we are stuck in this consolidation phase. It's a constant tug of war between the centralized promise of crypto and the centralized reality of global monetary policy. Let's bring the focus back home, because this is the biggest story for our local viewers. The Corporations Amendment Digital Assets Framework Bill 2025 is moving through Canberra. What is the core of this bill, and why is it such a game changer? This is huge. The government is essentially saying the Wild West days are over. The bill's primary goal is investor protection. It mandates that crypto exchanges and custody providers must secure an Australian Services Licence, AFSL. Think of it as bringing them under the same strict regulatory umbrella as your traditional banks and financial planners. It sets clear, enforceable rules for how they operate, how they hold your assets, and what happens if they fail. This is direct response to past failures like FTX, which had a significant impact on Australian investors. So it's about preventing another FTX-style failure on Australian soil. But there's always a debate. Does this tougher oversight stifle the innovation that crypto is built on, or does it actually unlock the next phase of growth? That's the crucial tension. The government's line is that it will unlock innovation by providing certainty. And they have a point. A clear regulatory framework is what institutional investors, the big super funds and asset managers have been waiting for. They can't touch an unregulated market. By making the market safer and more compliant, Australia could attract billions in institutional capital. However, the compliance costs for smaller local crypto businesses will be significant. We might see some consolidation, but ultimately, this bill is a necessary step toward making Australia a major, trusted global hub for digital assets. It's a long-term positive, even if it causes some short-term headaches. Shifting gears to the global stage, we saw European firm CoinShares withdraw its plan for 3 exchange-traded funds. Is this a sign of broader pessimism in the institutional space? I see this as a strategic pivot more than a sign of pessimism. The ETF market is becoming highly competitive and the regulatory path in Europe is complex. CoinShares is focusing on higher margin products. It tells us that the easy money in crypto is gone. Firms now have to be smart and efficient with their offerings. And what about the rest of the market? Let's talk about Ethereum. We saw some stability return after what was called Chicago data center chaos. Are the altcoins following Bitcoin's lead, or are they showing independent strength? The altcoins are still largely tethered to Bitcoin, but Ethereum is showing resilience. The chaos was a minor technical hiccup, quickly resolved, and ETH is grinding up slightly. Ethereum has actually shown a bit more strength recently, with some analysts pointing to improving macro developments. But for the broader altcoin market, the rule remains: when Bitcoin sneezes, the altcoins catch a cold. In a bear-leaning market, investors typically rotate out of the riskier, smaller cap altcoins and back into the relative safety of Bitcoin and Ethereum. So expect continued pressure on the smaller players until Bitcoin finds a clear direction. So let's look at the past, the short-term volatility. For the average Australian investor sitting on their hands right now, what's the long-term outlook? Where do I see Bitcoin heading over the next few years? The long-term picture remains incredibly bullish despite the current turbulence. The consensus among serious analysts and even a growing number of Australians is that Bitcoin will eventually break into the 150 and 250,000s range over the next few years. The fundamentals haven't changed. Limited supply, growing institutional adoption, and now a clear regulatory path here in Australia. The current price action is noise. The long-term trend is up. The key is patience and perspective. Don't get shaken out by the daily dips. Focus on the long-term adoption curve and the fact that Australia is positioning itself to be a leader in this space. That's the message, guys. Caution in the short term, but a strong focus on long-term potential, especially with Australia's new regulatory framework. But again, do your own research, guys. I'm not a financial advisor, and this is not a financial advice. And for all the in-depth news, analysis and information we couldn't fit into this segment, make sure you head over to our website, www.cryptologic.com.au. That's where you'll find all the details on the new digital asset bill, our full market reports, and more analysis on the central bank effect. That's all for today, or that's all the time we have for today, guys. Thank you for tuning in. Join us next time on CryptoLogic, and see you in the blockchain.